Hello everybody, welcome to Rachel's classroom. In this video we will be discussing on cost of preference share capital. The dividend paid to the preference shareholders is the cost of preference share capital. The cost of the preference share capital is based on the rate of return required by the firm's preference shareholders, which is determined by the market price of the preference shares. Since the preference dividend is not tax deductible, there is no need for tax adjustment in calculating the effective cost of preference share capital. Like the debentures, preference shares are also divided into two categories, irredeemable and redeemable. Now let's look at the formula that we will be using to solve our problems. In the case of irredeemable preference share capital, we will be using cost of preference share is equal to annual preference dividend divided by net proceeds. In the case of redeemable preference share capital, we will be using the next formula, cost of preference share is equal to annual cost divided by average value of redeemable preference shares. Let's look at this example. A company issued 6,000 8% preference shares of rupees 100 each. The flotation cost incurred is rupees 10,000. You are required to compute the cost of preference share capital if the shares are issued at three different situations: at par, at a premium of 10%, or at a discount of 10%. Now let's proceed to solve this problem. So the number of preference shares given is 6,000. Face value will be 6,000 into 100 rupees. So 6 lakhs. They said 8% dividend. So 8% on 6 lakhs will give you 48,000. The flotation cost is 10,000. So to proceed with computing net proceeds is, in the case of preference shares issued at par, is face value minus issue expenses. Issue expenses is 10,000. So 5,90,000. Therefore, the cost of preference share is 48,000 divided by 5,90,000 will give you 8.14%. Moving on to the next scenario. In case the preference shares are issued at a premium of 10%. Here we will be using face value minus issue expenses plus the premium on securities. So 6 lakhs minus issue expenses 10,000 plus 60,000 the premium paid on securities. So the net proceeds is 6,50,000. So the cost of preference shares is 48,000 divided by 6,50,000, which will give you 7.38%. The next situation is when the preference shares are issued at a discount of 10%. So to find net proceeds, face value minus issue expenses minus discount on securities. 6 lakhs is the face value, 10,000 issue expenses, and 60,000 is the discount on the securities, which will give you net proceeds of 5,30,000. So the cost of preference shares is 48,000 divided by 5,30,000, which will give you 9.06%. We'll see one more example to better understand redeemable preference shares. Now this is an example for redeemable preference shares. A company issued 9,009% preference shares of rupees 100 at a discount of 5%. The shares are redeemed at par after 9 years. The flotation cost is 2%. Find out the effective cost of preference capital. Let's proceed to solve this problem. So the number of redeemable preference shares is 9,000. Face value is 9,000 shares into 100, 9 lakhs. Dividend rate given is 9%. So the annual dividend is 9% on 9 lakhs, which is 81,000. Since we are issuing it at a discount 5%, the 5% will be calculated on the face value 9 lakhs. So 45,000. It is important we remember that it is redeemed after 9 years. Flotation cost is 2%. 2% on face value 9 lakhs will give you 18,000. To compute the annual cost, we calculate the preference dividend, which we have already done, 81,000, plus flotation cost is 18,000, but we have to amortize it. Here we are redeeming after 9 years, so we are dividing it by 9 years. So it is 2,000 plus discount on issue is 45,000. Again we are amortizing. So divided by the number of years after which we are redeeming, after 9 years. So we get 5,000. So the annual cost is 88,000. Let me remind you once again, since the preference dividend is not tax deductible, there is no need for tax adjustment in this problem. To find the average value of redeemable preference share, net proceeds plus redemption value divided by 2. Net proceeds is face value minus issue expenses minus the discount on securities. So it is 8,37,000. We are redeeming at par, so the redemption value is 9 lakhs. So adding net proceeds plus redemption value and dividing it by 2, we get the average value of redeemable preference shares as 8,68,500. So the cost of preference share is equal to 88,000 divided by 8,68,500 will give you 10.13%. Thank you.